Hi everybody, welcome to this video where we're going to break down, not all, but some of the key changes under the One Big Beautiful Bill Act to tax law that we've seen. Again, I want to emphasize this is a survey. Really, we're not going to look at every single thing in there. Really, this is reflective of some recent presentations I've given where I highlight at a high level some of the changes that may or may not impact you, especially individual taxpayers. So before we get started, as always, I want to remind you that this video is being provided for educational purposes only and is not intended to substitute for legal or tax advice. So with that, a little bit about me. If you followed this channel for a while, you know I provide a ton of education, and really that's kind of my main job and function now in the real world. So if you enjoy content like this and you want to get more into the technical nitty-gritty of tax, if you're a professional advisor, you can check out my educational newsletter, State of Estates, which you can find at griffinbridgers.substack.com. And while this material is intended for private wealth professionals who do this on a day-to-day basis and don't need individual advice, I do provide some actionable estate planning guidance for those who are directly needing their own estate planning motivation, especially if you need action guides that go beyond the basic, just get a will. So if you want to look at that, that's a newsletter I have called Inheritcy, which you can find at inheritcy.substack.com. So now that all the promo is out of the way, House Resolution 1, which was originally titled the One Big Beautiful Bill Act, was signed into law on July 4th of 2025. It had the effect of extending or making permanent many of the tax benefits that were created under the Tax Cuts and Jobs Act of 2017, but were set to sunset or go away at the end of this year. So as I mentioned, this is a highlight reel of some of those key extensions and even some of the additions to tax law that we can find in the new bill. Now, we can't cover all of the changes in the 175 pages or so that dealt with tax, but really our goal here is to give you some actionable insights. And a lot of these are going to deal with income tax, but we're going to come out of the gate with a handful that deal directly with estate gift and GST tax. So originally, what we had under the old law was the estate tax basic exclusion had a temporary increase effective back in 2017, 2018, where effectively the base was increased to 10 million. This was adjusted for inflation each year up to its current high, which is effective for 2025, of 13.99 million per U.S. citizen or resident. The original tax law before this change was set to reduce that inflation adjusted amount by 1/2 starting in 2026 by simply reducing the base for inflation adjustments from 10 million to 5 million. Luckily, we don't have to worry about that sunset anymore. So our new estate and gift tax basic exclusion starting in 2026 will be 15 million as a base, and then inflation adjustments to that $15 million base will start in 2027. And importantly, there's no sunset for this. The changes are permanent, or as permanent as you can get until Congress again gets together and decides to change the tax law. But as an extension of this, note that I emphasize this is for the estate tax basic exclusion, which also applies to your lifetime gift tax basic exclusion that applies after you exhaust any annual exclusions that you might have for lifetime taxable gifts. This also trickles down and is by reference the new GST tax exemption that you get, which is a separate independent exemption itself from the gift and estate tax exclusion. Now, I want to emphasize too, portability is unaffected. You can still port over the unused basic exclusion of a deceased spouse to a surviving spouse using the same election procedure, but subject to a case that came out earlier this year that I think emphasizes the importance of valuation reporting in seeking that portability election. So I cover that on my newsletter. I'd encourage you to check it out. Now, at the individual level, we now have the 2026 inflation adjustments, which is also covered on my newsletter if you want to go take a look at that in a prior article. But for the time being, what we have for 2025 and beyond is that the current Tax Cuts and Jobs Act brackets that were set to sunset to go back to a maximum rate of 39.6% no longer are applicable. Now we have the TCJA brackets extended, so we still get a maximum rate of 37%, and for the most part the same brackets, but with one difference, that the inflation adjustments to the end point of the 10% bracket and the start point of the 12% bracket have been adjusted some, so those brackets are slightly increased in 2027 and beyond compared to the others. We also have a slight bump effective for 2025 to what we originally thought was going to be our standard deduction for 2025. So you can see those numbers and those increases here in the middle, where effectively it's $15,750 for single filers, double that for married filing jointly, $23,625 for head of household. Now, there's still, for those who don't itemize, an additional standard deduction of $2,000 for those who reach age 65 during the year, and another $2,000 for those who are blind. Those amounts are reduced to $1,600 per spouse. Really, there's no change to that other than the standard deduction itself requires you to not itemize. So here is a quick rundown of what we see as our current brackets and the 2026 brackets that have been changed. Now, a new addition and an extension of an old, exclusion is that back in the Tax Cuts and Jobs Act, they had gotten rid of the personal exemptions that you could claim for dependents or children that you used to be able to claim on your tax return. That has now been made permanent. There's no more personal exemption for individuals. There's still one that you can get for trusts and estates under Code Section 642B. We won't dive into the specifics on that. But there's also a new deduction, which is technically classified in the same code section as the personal exemption, which is a new deduction for those reaching age 65 in years 2025 or through 2029. Now, that's a flat $6,000 amount. It's not adjusted for inflation. It phases out pretty early when your modified AGI exceeds 75,000 or 150,000 married filing jointly. So effectively, that full phase out hits when you reach 175,000 single or 350 married filing jointly. Now, you get this in addition to that additional standard deduction for reaching age 65 if you're not itemizing. But importantly, if you choose to itemize, you still get this deduction. It's a below-the-line deduction, but it's not an itemized deduction. You will get this no matter what. We have a slight expansion of the child tax credit, and it has now been made permanent. Effectively, it's been increased to $2,000 per qualifying child, up to $2,200 as a base for 2025. Then starting in 2026, we'll see inflation adjustments to that each year. The phase-out thresholds for that are increased to $400,000 married filing jointly, or $200,000 for all filing statuses, all others, I should say. However, there's no inflation adjustment for these phase-out thresholds, even though there is one for the base amount of the credit, the new base being $2,200. So here's a quick rundown, where we put these deductions side by side, looking at what non-itemizers can get versus itemizers. But note that whether you're itemizing or not, you still get this new senior deduction if you so qualify. But what we're now going to see, one carved out that we'll talk about in the rest of this, is an expansion of what are often known as below-the-line deductions that don't reduce your AGI, but nonetheless you can get those deductions regardless of whether or not you choose to itemize. But then we'll have some other limitations we need to be aware of with respect to itemized deductions moving forward. So with that, one of the pain points of the Tax Cuts and Jobs Act was the prohibition on deducting miscellaneous itemized deductions. Those were the deductions you could receive, to the extent they exceeded in total 2% of your AGI. But we no longer have those deductions. That temporary prohibition of this type of deduction has now been made permanent. Where this has the greatest impact, perhaps, is where you have fees for tax and investment advice, which are classified as miscellaneous itemized deductions and thus are no longer deductible. That's a continuation of what we've seen over the last few years, but there are ways you might possibly find suitable workarounds. One you can find in the case of lender management, where effectively, you can look into certain structures where investment advice could be more unique to a family and be more in the nature of a business expense and, as part of a trade or business, and not necessarily advice for investments per se. We won't dive into the specifics there, but I also want to emphasize that trusts may be able to deduct expenses for tax and investment advice if the expense itself is unique to the administration of the trust. One good, I think, dividing line to look at is to compare if the assets were held in trust versus whether they're held individually. If the expense is of a nature that it doesn't matter, it would still be the same expense whether it's held in trust or held individually, you can't deduct it even at the trust level. However, if it's an expense that's incurred by the trust that wouldn't be incurred if the assets were held individually, that might indicate an expense that's unique to the administration of the trust and thus might be deductible. But keep in mind, that's only for a trust that is actually taxed on its income. So if you have a grantor trust, that would not be a deduction you could claim because the individual grantor or another person is treated as the income tax owner of those assets and includes them all on their personal return as if they were the direct owner of those assets to begin with. So as we mentioned, we have this broad expansion and stratification of what we now see as below the line deductions. So we used to think of above the line to arrive at AGI that everybody would get versus itemized deductions, which you can only get if you itemized. And again, typically the standard was that you choose between the greater of your itemized deductions or your standard deduction in deciding to do so. Now, that wasn't a hard and fast test, yet there were some gray areas to if and when you might do so, but we now see a middle ground where there's non-itemized deductions that you get no matter what, but nonetheless they don't reduce your AGI. We're calling these below the line deductions. So we talked about the senior deduction. Some others aren't necessarily new. We see the deduction for up to 20% of your qualified business income under Code Section 199 Cap A. There was a new non-itemized or charitable deduction added under Code Section 170P that has now been slightly expanded. And then we see some new deductions for qualified tip income, qualified overtime compensation, and qualified passenger vehicle loan interest. All three of these deductions, the new ones, are given a limited shelf life, much like the senior deduction is. But as we'll see, the QBI and non-itemizer charitable deductions have been made permanent now and won't go away after 2028 or 2029. Now, starting in 2026, after you've calculated out all of your itemized deductions and taken out all of the limitations we're going to talk about on some of those deductions coming up, there's a new haircut you have to take off of the maximum itemized deductions that you can indeed claim and deduct. Effectively, where this kicks in is only when your taxable income with itemized deductions added back in exceeds the 37% rate bracket start point. So if before taking out your itemized deductions, you're over that 37% threshold, that's where you'd need to make this calculation. If you're still below that 37% bracket start point, you don't have to worry about this. But once you're over, you get kicked into this world where you have to reduce your itemized deductions by 2/37 of the lesser of two amounts. One is itemized deductions themselves, or, if less, the amount by which your taxable income with itemized deductions added back in exceeds that 37% rate bracket start point. Now, this doesn't start until 2026, which is the good news. The bad news is that this phase out, which previously only applied to individuals, now appears to apply to estates and non-grantor trusts as well. In the law that exists through the end of this year under Code Section 68E, it says that estates and trusts are omitted from the previous itemized deduction, the old P's limitation, but that code section and this carve-out for estates and trusts was omitted in the new law. So it was unknown whether this was an intentional omission at first, but there is a Senate Finance Committee summary of OBBBA's changes that seems to indicate that this omission was indeed intentional. So we're waiting on guidance, especially because if you're used to dealing with estates and trusts, you know that itemized deductions isn't really a consideration. So forcing a definition of itemized deductions that applies to an individual into the world of trusts and estates can be difficult because there's a handful of deductions where it's kind of questionable as to whether or not that would be, quote unquote, an itemized deduction to the trust. Some examples might include under Code Section 642C, where a trust can get a charitable income tax deduction for any payment of its gross income over to charitable purposes. Another one might be Code Section 691C that gives any recipient of income in respect of a decedent a deduction for estate tax attributable to that income. So that affects estates and trusts that, for example, might have IRAs or qualified plan assets paid to them at death that generate estate tax, so that deduction might be itemized and might result in a small haircut here. Now, under the Tax Cuts and Jobs Act, there had been what was initially a temporary reduction of the maximum acquisition indebtedness under which you could subtract or deduct your interest, along with a prohibition on deducting interest on home equity indebtedness. However, this reduction and elimination of interest on home equity indebtedness has now been made permanent. So we have a maximum acquisition indebtedness for which we can deduct interest now of $750,000, half that if you're married filing separately, and that is not inflation adjusted. So we have that flat amount moving forward as well. But keep in mind that this reduction and this limitation only applies to mortgages issued after December 15th of 2017. Now here's where we really get into some interesting territory, and that is on charitable deductions. So there is, as I mentioned earlier, that if you choose not to itemize, a small non-itemizer charitable deduction you can receive. It's only available for generally cash contributions to a charity other than a DAF or a supporting organization. That was $300 or $600 married filing jointly, but it's going to be increased starting in 2026 to $1,000 or $2,000 married filing jointly. Now, what we're going to discuss on the floor rule that's being added in 2026 doesn't apply to that non-itemizer deduction. But what we do see is a new floor starting in 2026 for itemizers that says if you're itemizing your deductions, you cannot deduct your charitable contributions except to the extent they exceed 0.5% of your quote-unquote contribution base. Now, your contribution base is generally your AGI, but without reducing for net operating loss carrybacks. However, net operating loss carrybacks other than farming losses have been, eliminated. So in most cases, we're going to treat this as being 0.5% of your AGI as being the floor. So if you are making contributions, you have to make sure you exceed 0.5% of your AGI in order for them to be deductible if you're going to end up itemizing. Now, We also have a top limit. There's certain percentages that have always applied, depending on the type of contribution and the type of charity involved, where in any given year you can only deduct up to 50%, 60%, 30%, whatever of your AGI, and any excess over that amount under previous laws and still under new laws would carry over. Now, as we're looking at those limitations, the 60% limitation for cash contributions to a public charity was set to sunset, but it itself has been made permanent. That's the good news. The bad news is we're still subject to that new 0.5% floor starting in 2026. And now, since we can carry over amounts over that top end threshold, can we carry over amounts under this floor threshold? And the answer is yes, but only if you have an excess over that top end threshold for that specific type of contribution. We'll look at an example of that. But either way, to carry over the 0.5% floor that's otherwise disallowed, you have to have a corresponding excess over that top end percentage. So here's a quick illustration. So simple math, we're assuming we have an AGI of 100,000 and a cash contribution to a public charity of 60,000 and $1. We'll explain why $1 in a minute, such that we're within that 60% limitation of AGI as to what we can deduct in the year of contribution. Now in this case, when we carve off 0.5% of our AGI, that gives us 500. That's a floor. The first 500 we can't deduct. We can only deduct the amount over that. So effectively we have 59,501 left. But that $1 puts us over that 60% threshold. It itself, it would typically be carried over even under the old rules. But by $1 creating that excess over the 60% here, that allows us to then also carry over the 500 that was disallowed under our 0.5% floor rule. So this illustrates how maybe intentional planning even $1 over any of those applicable carryover thresholds could allow us to also carry over the portion, at least within that contribution band, that generated a disallowed amount below the 0.5% floor. Now this will get kind of hairy when we mix different types of contributions and different AGI limitations at the top end, but we won't get into that complicated math because it's hard enough to illustrate as is. Now, state and local taxes. One of the biggest pain points of the Tax Cuts and Jobs Act was this limitation on how much of your state and local income and property taxes you could deduct in any given year. That was capped at $10,000 under the Tax Cuts and Jobs Act. A lot of people were looking forward to the possibility that this might sunset and go away after 2025. Unfortunately, it will not. But what we do get effective for 2025, this year, so we don't have to wait, is a new upper limit that we can deduct up to $40,000 of our state and local income and property taxes. And that upper limit will increase by 100% for each of the next 4 years, so 2026, 27, 28, and 29, after which in 2030, it's going to go back to a maximum limitation of $10,000. So the $10,000 has been made permanent effectively, but with a temporary bump for 2025 through 2029, starting at $40,000 and going up effectively by 101% for each of the next 4 years. However, there is a phase-out limit where this starts to be reduced by 30% of the excess of your modified AGI over a certain threshold. That threshold is $500,000 for 2025, or half that for married filing separately. That threshold itself also increases by 101% annually each of the next 4 years. So that reduces that upper limitation of $40,000 by 30% of that excess, but the reduction can't be below $10,000. So no matter what, you're guaranteed a $10,000 state and local income and property tax deduction, but that higher amount does have a phase out after $500,000. So here's a quick illustration of how these might fit together. Really I stacked up next to us where perhaps we're looking at $100,000 of taxable income with our itemized deductions added back in. Now, before we get into this total itemized deduction limitation, you have to take out all those deduction specific limitations to start. So we have these limitations that are specific to charitable we talked about. We have these limitations specific to state and local taxes or SALT that we talked about. We take those out first, and then we get into this broader final calculation of our total itemized deductions, and we look at between these two columns, one, the 100,000 with those tentative itemized deductions added back in, and then total itemized deductions, and we take 2/37 of the lesser of those two amounts, and that's the amount by which our itemized deductions are reduced. Now, in this example, we don't have to worry about this effectively until we exceed the 37% rate bracket with our itemized deductions added back in, because it's the lesser of the amount by which you exceed the start point of that bracket or your itemized deductions. So if you don't exceed the bracket, you're taking effectively the lesser of 0 or your itemized deductions, and obviously 0 is going to be the lesser of that. So that means we don't have to worry about this until our tentative itemized deductions push us potentially into that 37% rate bracket. Now, if you own an interest in a business that's not taxed as a C corporation, so if you have a pass-through interest or even potentially sole proprietorships, depending on the type of business, one of the new additions that was temporary initially under the Tax Cuts and Jobs Act was a deduction, again, a below-the-line deduction that you can get regardless of whether or not you itemize, but that doesn't reduce your AGI, of up to 20% of your QBI, your qualified business income, in any given year. This has now been made permanent. Now, there are a lot of back and forths initially on what this would look like in its new permanence, but ultimately what shook out is that we have a new minimum QBI that we can deduct in any given year, notwithstanding the other phase-outs of this, where you can take out at least at least 400 of your qualified business income in a given year. We won't explain the different phase-outs and everything, but effectively there's points at which your QBI that you can deduct starts to be reduced, and there's points at which you start to run into an inability to deduct QBI for specified service trades or businesses. And those points kick in when you take a threshold amount added in with a phase-in threshold, the amount by which you can exceed the threshold amount. That amount by which you can exceed the threshold amount has been increased. It was $100,000 for married filing jointly. It's been increased to $150,000. Then for all other filing statuses and for estates and non-grantor trusts, it was $50,000. That's been increased to $75,000. Now we have new numbers for 2026 that aren't covered here, but effectively those raise our threshold to be able to take the QBI deduction before we have to start phasing it out, before we have to start worrying about things like W-2 wages and the unadjusted basis of qualified business property, and importantly, the amount by which, as long as we don't exceed that threshold point, we can still deduct QBI for specified service trades or businesses. Now, in this, we borrow a definition from Code Section 1202E, which deals with qualified small business stock, and we'll get into that. But importantly, for the QBI deduction, engineering and architecture are carved out. Those don't count as specified service trades or businesses here. But generally everything else within this definition would. So I think it's important to be conscious about that, especially because, too, the same definition is going to carry over to a couple of deductions we're going to talk about with qualified tips and qualified overtime compensation. But for now, let's say you don't have a pass-through business. Let's say you're operating as a C corporation. If you ever get to a point where you are selling that C corporation stock and that generates gain, this might be of interest to you because there is an exclusion, and has been since 1993, where a portion, at least, of your gain for the sale of qualified small business stock can be excluded from your gross income. Now, there's a lot of requirements you have to meet in terms of the types of businesses that qualify. Again, going back to that definition, at the very least, this doesn't work for a business that is a specified service, trade, or business. But under old law, it used to be that, you had to have a C corporation. That's still a requirement. But you had to have a maximum aggregate assets limit of 50 million tested, one, when the business is created, and two, when the qualified small business stock is issued. And if you were over that maximum business size, you wouldn't qualify for this gain exclusion. Now, this 50 million, as we're going to see, has now been increased to 75 million and has kind of retroactive effect going even back to 1993 in terms of the businesses that are encapsulated within this broader funding limit definition that could count. So, again, I want to emphasize this isn't available for every business. You have to have C corporation stock that is original issue for cash or property or services in order to qualify for this gain exclusion to begin with. Now, under old law, we'd moved to, depending on the time of issuance, that you could get a gain exclusion of up to 100% of your gain, but capped at $10 million for your life, or if greater, 10 times the basis of the QSBS that you received, so long as that QSBS had been held more than 5 years. But now we have some different rules. Now, these new rules only apply, at the shareholder level for QSBS that is issued after the date of enactment of OBBBA. So that means OBBBA was enacted on July 4th. So that means that QSBS issued on July 5th or after will get the benefit of a bigger lifetime gain exclusion of $15 million, which is adjusted for inflation in 2027 and beyond. But we now have a tiered gain exclusion. Instead of 100% if you've held for more than 5 years, we now get a 50% gain exclusion, which then counts against that 15 million or 10 times basis if greater. But it's 50% if you've held the stock at least 3 years, but fewer than 4. Goes up to 75% if you held it at least 4 years, but fewer than 5. And then 100% once you hit 5 years or more. So effectively, we've added a day to when we can get the 100% gain exclusion. It used to be more than 5 years. Now it's 5 years or more. But again, I want to emphasize too, we also have at the business level this maximum aggregate assets limitation that has been increased to 75 million, and for newly capitalized businesses or newly issued QSBS, that itself is adjusted for inflation in 2027 and beyond. So this kind of has the effect of bringing along some older C corporations that might have been over that $50 million limit, but what this can retroactively cause is some of that previously issued stock potentially to be QSBS if you can prove that the corporation hadn't exceeded the $75 million limit at the time of issuance and at the time of formation, which is a lot easier said than done and illustrated and proven. So the 15 million and the 75 million are adjusted for inflation after 2026, so starting in 2027. Now that $15 million gain exclusion, it kicks in and applies to the 50%, 75%, or 100% of the gain you're excluded. So this is kind of a lifetime limitation where you can use this in one chunk or in little swoops. But these inflation adjustments that you get while they grow that base 15 million over time, once you've used up the entire lifetime dollar limit you have with inflation adjustments, you won't get the benefit of any future years inflation adjustments here. So that's one thing to keep in mind as well. So here's a quick carve out, a quick illustration I did. By no means is this perfect, but it kind of illustrates a couple of things. One, on the left, we have our usual assumptions we'd have in terms of starting with basis, then 15 million, or if greater, 10 times basis of a potential gain exclusion, and then possibly gain being taxed once those limits are exhausted. But to the right of that, there's a few things you have to carve out. One, you might have 50% or 25% of your gains still recognized, depending on your holding period, as long as you're over 3 years. And then you also get this rule where if you're putting appreciated property into a C corporation in exchange for stock, any built-in gain in that property can't be excluded under the QSBS basis rule. So at the bottom, you'll see this red box, difference between your basis and contributed fair market value. That itself would still be taxed and couldn't be excluded from gain here. So that seems like more of an advanced topic. We're now going to get into more, individual new deductions that are more relevant to individual shareholders. One was partial fulfillment of one of Trump's campaign promises, which was to not tax tips. However, what this means is that tips are technically still included in your gross income, but instead of excluding them from that, you're going to get a deduction of up to $25,000 of your qualified tip income in any given year. Now, we only get this for 2025, 2026, 2027, and 2028. It only applies to cash tips, and importantly, it only applies to cash tips that are received in an occupation which customarily and regularly receive tips on or before December 31 of 2024. Effectively, what this means is you can't suddenly pivot your business to tip only and get this deduction. Now, there's another limitation that says beyond just this list, which we now have guidance on of the occupations that customarily and regularly receive tips, we also have that specified service trades or businesses definition that we looked at with QBI. If you're in any of those trades or businesses, you can't get this deduction period at all. It doesn't matter. So that's one thing to keep in mind. You're stacking up, one, that list of specified service trades or businesses against the list of trades or businesses that are traditionally of the type that receive tips before 2025. So some of those could be exclusionary when you stack those up. Now, there's a couple things to keep in mind. One, if you receive this individually, you get the full deduction, but there is a phase out, as we kind of mentioned back here, once you exceed modified AGI of 150,000 or 300,000 married filing jointly. We also need to note that, if you have your own trade or business that you're accounting for tax purposes and you're receiving tips in that, you can only deduct the tips after you take out all other trade or business deductions that you have. So effectively, the tips are only net of every other business deduction that might be incurred in that situation. However, receiving tips doesn't necessarily mean you're in a trade or business to begin with. It just means that if you are indeed operating a trade or business, there's a limit potentially on what you can deduct on the accounting side. You can't send yourself into the negative in terms of the trade or business income that you receive. Now, another point that often flies under the radar is that the tips must be voluntary. So if you have mandatory gratuities and service charges, like in the restaurant business for a certain party size, those technically don't count under this definition. On that note, in addition to the deduction for qualified tips, we also find a new deduction for qualified overtime compensation. Much like the tips deduction, we only get it for a 4-year period, 2025 through 2028. We have the same $25,000 limit and phase out that applies. And the two kind of shoehorn together, as we'll look at in a minute. But for the time being, the central point to consider here is that your deduction is limited to the excess over your regular rate of compensation. So, for example, if you are paid time and a half for overtime, you can only deduct the half that exceeds your usual hourly rate of pay, for example. Now, how does this fit into qualified tip income? Well, technically, if you're an hourly worker who relies on tips, your employer often will pay you a certain hourly rate, maybe below minimum wage, and the tips are technically in excess of your normal rate of compensation. So does that mean you can claim tips as qualified overtime compensation? The answer is no. The new law treats this and clarifies that qualified tips aren't overtime compensation. So you don't get to double dip and you don't get the best of both worlds there. On that note, with both the tips deduction and the overtime compensation deduction, I think it's important to emphasize again that those are below the line. They don't reduce AGI. They're also subject to self-employment taxes, so you need to keep those in mind. And on that note, I can't accept tips from you, but if you value this content and you're enjoying this, I'd encourage you to register for my newsletter, State of Estates, which you can access by scanning the QR code or at griffinbridgers.substack.com. Back to the program. Our final new deduction that we get a limited shelf life for, once again, is qualified passenger vehicle loan interest. So we get the same 4-year period, 2025 through 2028, where you can deduct up to $10,000 of interest on qualified indebtedness that is used to acquire a passenger vehicle. So there's a couple notes on this. One, this has to be for a vehicle for which the original use is with the purchaser. Effectively, that means you have to buy a brand new car to get this benefit. You can't buy a used vehicle where somebody else was the first to use it. This also applies to vehicles that, at least in part appear to be used for personal use. So vehicles that are 100% for commercial purposes, you can't take this deduction for, even though there might be a business level deduction depending on the circumstance on that type of depreciable asset. Same thing for fleet vehicles, but the law isn't clear on whether, for example, if you use your personal vehicle in part for business purposes, whether or not this would affect your deduction. Arguably, you could still take this deduction in that situation, but there's nothing breaking down business use versus personal use in the law as we see right now. Now, we get this deduction for 2025, but the debt has to be incurred after 12/31 of 2024. Now, this can include refinancing up to the amount of the refinanced indebtedness if you want to be able to claim this deduction itself. So, while this seems perhaps more restrictive than it is, the other caveat is that this can only apply to a vehicle for which final assembly took place in the United States. Now, that's not defined clearly, but obviously parts and different elements of the manufacture are put together in other countries and may be imported into the U.S., may be subject to tariffs, but a lot of the major automakers have a plant where they're carrying out final assembly here in the U.S. So arguably, even for foreign brands, a lot of them would meet this requirement as well. Now, an interesting point is that the original House bill before the Senate amendments proposed including things like RVs, whether self-propelled or towed within this, and may have included ATVs, for example. However, for the most part, those types of recreational vehicles have been wiped out. Instead, we now have just 2 or 4 wheeled vehicles generally that are street legal and under 14,000 pounds. If you meet those, you're typically going to see this. But I emphasize the street legal part, where especially for a 2-wheeled vehicle, motorcycles that you have to register and get a license plate for, those might qualify, even though they may not technically be passenger vehicles. But things like e-bikes may not qualify. So this, like the others, does not reduce AGI. It's a below-the-line deduction, but you get it regardless of whether you itemize, along with the tips deduction and the overtime deduction. Now, one additional requirement is that lenders will be required to provide an annual return on a 1099 for interest of $600 or more, which raises an interesting question of, okay, how do you technically prove this for loans if you have multiple ones where the interest is below $600 for the year? We won't answer that here, but that's a quick rundown of the deduction for qualified passenger vehicle loan interest. Now, for 529 accounts, while a lot of these changes are at the federal level and really have to be adopted at the state level for state 529 plan administrators, there's been some expansions where there's added ability to take qualified educational expenses for elementary and secondary school tuition to include some other elements in there. The big one, though, is that you don't have to be in a school or degree-seeking program. What we now have added is a recognition that qualified educational expenses can also include post-secondary credentialing. So anything you're pursuing to, for example, get a securities license or any other license, your tuition expenses, books, materials, testing, all of those and the fees relating to that can be within the new category of post-secondary credentialing expenses. This can also include your continuing education expenses as well, if you want to pay those from a 529 plan instead of taking them at the business level. So all of those are now within the realm of possibility if you're looking to find a new profession or career that requires specific licensure or training. Now, this does require a quote-unquote recognized post-secondary credentialing program, but the list is fairly broad, and I think a good way to think of it is anything that you have to be licensed to do at the state or federal level, whether it's a license from an agency or elsewhere, will generally fall into this, and any education expenses relating to pursuing that credential would fall in as well. Which brings us to Trump accounts. Now, this is an area where we're still waiting on a lot of guidance, especially in how they are initially established. So, diving in, the broader purpose of these is recognizing that there's no functional equivalent of an IRA for minors who might not have earned income and thus may not have the type of income that allows them to fund an IRA to begin with. Now, obviously, at some point, children can start to work, but that might be age 14 plus. So what do we do for the first 14 years, for example, in that scenario? So Trump accounts are designed to fill that gap. Now, what we don't have guidance on, as I mentioned, is how these are created. Presumably, there will be further guidance on how they can be created beyond just one simple program that has been floated for now. But for now, it looks like the only way to establish this is with a certain level of seed funding from the U.S. government, which comes in the form of what's been proposed, but doesn't appear on, at least on my review, the draft form of the Form 1040 for 2026 right now, is kind of an election to effectively divert $1,000 of your tax liability from Treasury to a Trump account for a child. Now, there's also some limitations on this, where really this is only for a child born between January 1 of 2025 and December 31 of 2028. But beyond that, once an account actually exists, which we don't know exactly how we get there outside of this proposed funding mechanism, we run into various methods of funding where anybody can fund them up to $5,000 annually, and that $5,000 cap is adjusted for inflation. And effectively, once funded, these are treated as IRAs. Now, we'll get into the nature of that funding in a minute, but we also see things where while there's that $5,000 cap, there's some other types of contributions that don't run up against that $5,000 limit. There can be qualified general contributions from governmental or charitable entities. Those aren't capped. There can be a rollover. Now, this has to be in the form of a trustee-to-trustee transfer only, but the rollover has to come from another Trump account, and it has to be for the entire balance of that Trump account being transferred. We'll see that employers can contribute up to $2,500 annually, and then obviously the Treasury seed funding we just saw that doesn't count against the $5,000 annual limit. Now, the nature of these contributions is interesting because they're going to be after tax. The contributions that are made before the year in which the beneficiary reaches age 18 are not deductible. So effectively, this is going to be of a nature where you're going to have a basis in the IRA and then some earnings, and any distributions are going to be taxed under the rules of Code Section 72 that recognize that each distribution is proportionally, 1, your tax-free return of basis, or 2, the earnings on that contribution. Now, until the year in which the beneficiary reaches the age of 18, it's subject to the Trump account rules. Starting in that year and after, presumably this would be treated as if it's a normal IRA, just one with basis, technically. Now, until age 18, or that year in which they reach the age of 18, the cash proceeds that are put into the Trump account, which it seems to be the limitation on funding to begin with, and it has to be in cash, they have to be generally invested in index funds, usually mutual funds or ETFs, and the expense ratio will have to be 0.1% or less. Now, starting January 1 of the year in which the child reaches the age of 18, they can start receiving distributions. No distributions are permitted before then, although in the year the beneficiary reaches the age of 17, they could roll over the Trump account in full to an ABLE account, again, in a trustee-to-trustee transfer of the entire account balance. Now, from here, like I said, this is generally taxed like an IRA under Code Section 72, but what isn't clear, presumably what we would run into is that, yes, we would have that early withdrawal penalty of 10% if a child takes the money out before age 59 and a half, at least, to the extent the rule under 72 doesn't give us a hardship exception or anything like that. Now, this wasn't within OBBBA, but I think it's also important to note that there's now finalized regulations on catch-up contributions, where the ability to make catch-up contributions was expanded under the Secure Act 2.0. So effectively now we have a catch-up where starting in the year that you will reach age 50, you can add $7,500 to an IRA or qualified plan, and that amount increases to $150,000 for those reaching ages 60 to 63 by year end. So where this is a contribution to a qualified plan, this new rule says that the employer-sponsored plan must put the catch-up contribution into an after-tax Roth account, a Roth 401k or otherwise, if the participant's Social Security wages exceed a certain threshold for the year. Now, that amount is $145,000, and it's indexed for inflation for years after 2024. We don't yet know what that amount will be because this requirement isn't going to kick in until 2027. But nonetheless, this is something looming and coming down the pike. And it's contingent too upon a plan accepting catch-up contributions to begin with. Now, within that, if a plan accepts catch-up contributions and doesn't have a Roth account option, then there will be some decisions to be made on whether they add the Roth option or if you just piecemeal don't allow catch-up contributions anymore because you don't have a Roth option. So with that brings us to the end in our comprehensive list of changes. So in some areas, we have a bit more certainty, but others, like we've seen, are subject to a temporary shelf life. So while we have permanent changes, I think it's easy to note that when you're reading the code, those are originally drafted as bolt-ons, and really what we see is though those are continuing as bolt-ons, and perhaps that makes them easier to legislatively remove in the future. Things like the current tax brackets, which are found in Code Section 1J that overrides Code Section 1A, and the personal exemption, for example. So ultimately, in terms of broader planning strategies, we have irrevocable trust planning that could benefit from non-grantor status for things like the QBI deduction, the SALT deduction, and the QSBS gain exclusion. But you have to pay very special attention to the tax status of the trust. It's very easy to take for granted that a trust may be set up as a grantor trust, maybe not even by its terms, but by the selection of trustee, for example. When it comes to getting assets into those trusts for those purposes, it's important to consider the question of completed gift versus incomplete gift transfers, given a slightly increased lifetime gift tax exclusion that we could use. And it's still wise to use that for appreciating assets, especially those with a higher basis, because the alternative, holding at death, gives us basis step-up opportunities. So still striking that balance between estate and gift tax planning versus income tax planning is key. and you might be able to do some upstream planning to borrow the enhanced exemptions from, well, for example, ancestors in your family tree. Now, QSBS seems like a sweet opportunity, but it's still full of traps requiring diligent tracking and documentation both at the business level and at the shareholder level. And it's, I think as long as we're looking at this, we talked about completed gifts versus incomplete gifts. And in my opinion, it's not clear under the rules whether a transfer of QSBS from an individual to an incomplete gift trust may qualify for the gain exclusion. At worst, that makes you fail the original issue requirement. So ideally, you have a completed gift or original issuance to trust directly, but obviously we can't always do that. But it gives us an opportunity to, at the point of capitalization, where, for example, if we're going to roll into a new entity that is eligible for QSBS, we can be conscious about how we're planning for trust ownership at the moment of original issue. Itemized deduction limitations are kind of an accounting and calculation nightmare, but where they're really going to be a nightmare is with those same non-grantor trusts we just discussed, that those now present, while small, relatively a cost to doing business as a non-grantor trust, not to mention the issue for higher income individuals who might be subject to those limitations. We also have updated Secure Act regulations, like I said, that create some certainty with IRAs payable to trust, but can create some uncertainty on issues like we just discussed with catch-up contributions. Now, with grantor trusts, we may have to be aware, too, on the itemized deduction side, and even on the charitable deduction side, or with all of these deductions that have AGI caps, on the effect of aggregating your trust income with the grantor's own income and deductions. So, for example, this could have an outsized impact where maybe if you're doing charitable planning, 0.5% of your AGI is no longer just your income. It includes the income of the trust that is being attributed to you. And on that note, as we're looking at things like non-grantor trust, an issue that has flown under the radar but will become more important is trust aggregation. So what's to stop you from going out and setting up a ton of different non-grantor trusts to own QSBS or assets that give you the QBI deduction or anything? And what's to stop you is this rule in Code Section 643F that can cause two or more trusts to be effectively combined for income tax purposes and treated as one trust. So effectively, to get there, what we have to have is substantially the same grantor, substantially the same primary beneficiary, and important, a third prong, a principal purpose to avoid income tax. Now, I emphasize that last point because it could possibly save you when we look at the difference between a completed gift trust versus an incomplete gift trust, where the incomplete gift trust might primarily be set up for income tax purposes, which would clearly bring it within that anti-abuse rule. But if you're making a completed gift transfer, for example, you could make the argument that you're primarily doing it to save transfer tax and not necessarily income tax, especially, for example, in a situation where spouses each set up identical trusts for each of their children. In that scenario, typically what the rule of Section 643F says is that spouses will be treated as one person, as one grantor for purposes of that rule. So typically what that would mean is that identical trust of spouses would get combined if they have a principal purpose to avoid income tax. But if each spouse is using their own lifetime gift exemption and their own lifetime GST exemption to fund that trust, you could make the argument that you're funding it for purposes of avoiding estate and GST tax and not necessarily income tax as well. Now, for existing trusts, I think it's also important to note that this applies to the contribution of cash to property to existing trusts as well. So, for example, if you had a grantor trust and you're pivoting to non-grantor trust status, that itself could be a situation where ultimately maybe there's a new contribution to the trust that we need to consider within this aggregation. Now, what's not clear is we have this ruling from the IRS in 2023-2 that says that you don't get a step up in basis for stock in a grantor trust at the grantor's death that isn't included in the grantor's gross estate. Effectively, what that ruling was looking at is the deemed income tax only transfer of ownership from grantor to trust treated as a transfer at death that entitles you to a step up in basis. The IRS said no there, but could they go against that and argue that in this scenario, the transfer or the transition from grantor trust to non-grantor trust itself falls within the purview of this rule? We don't know. Time will tell, but I think that's an important consideration to make as well if you're toggling off grantor trust status. Which brings us to the end. Thank you for participating in this educational video. I hope it brought you some value. If you have any questions, feel free to reach out. And if you would like additional learning resources, obviously you can check out my newsletter, griffinbridgers.substack.com, which is designed for wealth transfer professionals who want educational content like this. But I thank you for joining me for this video, and I look forward to seeing you in my future content.